Welcome, everybody. Today we have the 28th of July 2016, and it's a pleasure for me to have you once again within the webinar series Developing Superb Trading Strategies. My name is Stefan, and of course I want to mention Argus FX as a broker who makes it possible to have that kind of webinar series for you. And it's a pleasure to work with Argus together. It's our partner, and I'm a partner of Argus, and for Argus, I am a partner. So that's quite easy. During the week, I got a couple of questions, and I want to share with you two of those questions and the corresponding answers to those questions of last week, because it might be of interest for everybody. In total, we have three topics for today's webinar. I want to start exactly with those questions and answers from last week. And then I want to do the first step into getting a real trading strategy that you can see the context and how I do such kind of development of a trading strategy. I want to use as an example Dax strategy running on a daily base, so a D1 strategy, and in principle that strategy is based on an EMA. But let's start with that later. During that development, or that first step of development, and the final step will be done next week, and maybe even the week after. Don't know exactly how much time we need for that, but for today, I want to focus a little bit what I personally call the neighborhood analysis, and that has to do with avoiding over-optimization of trading strategies. So that basic concept I want to present today, and those are the three topics. Let's start with something from last week. You might remember that last week we talk about ATR multipliers, or the ATR in general, and how to calculate it in Excel, for example. And we realized how it goes and what kind of numbers we get. And I mentioned already that I personally use within trading strategies the ATR, or better to say an ATR multiplier, for stop loss settings. And of course, since I do an optimization of my strategies, that is at first and simply a degree of freedom, or let's call it simply a parameter, in order to have that kind of multiplier based on an ATR to get a stop loss. And the question which came from one participant was, I have a certain strategy running on a weekly base of I think it has been stocks, and maybe can you give me a hint of how I can do such a calculation or get a good multiplier for my personal strategy? Of course, I cannot, since I don't know the exact details of that strategy, I cannot give a specific answer in terms of it should be 1.3, and that will be the best parameter. But I can show you how you, for your own strategies, might get a suitable number for that ATR multiplier. And the way to go is to use so-called Bollinger Bands. Bollinger Bands are based on the ATR plus a moving average, and let's have a look to how that can work in order to get a certain multiplier. So I use here, because the participant mentioned he's working on a weekly base, I now go simply to the DAX, for example, and we have here the DAX as a chart on a W1 base. And he mentioned already that he uses an ATR period of 14, and that is the ATR which is plotted here in the lower window of my screen. But now the question is, how can I get for my strategy a good ATR multiplier? And that can be done, for example, via the so-called Bollinger Bands. Because I now put here the Bollinger Bands on that chart, and even, okay, that is now in German, funny enough, but it's quite easy. We have to use the period, which, okay, we take 14, which is on a weekly base just the quarter of 1 year. And then the next step is the so-called deviation. The German word is Abweichungen. And that is exactly what I mean with ATR multiplier. I use, just for the beginning, the value 1, and then we get that kind of plot. The Bollinger Band is always a central line, and we have an upper line and a lower line. The upper line is simply the moving average plus ATR times multiplier, and the multiplier is called deviation in the MT4 indicator, and the lower is simply the moving average minus this deviation, so ATR times ATR multiplier. And now you can see, because I mentioned you might get an first hint on where to set the stop loss based on an ATR multiplier, and that is, he mentioned for his strategy he uses the weekly chart as a base, and then looking for classical technical analysis for good entry points. And let's assume we are within that time frame here. Of course, we would look for long entries, and whenever that long entry would be triggered, or we would start a trade, I can ask myself, okay, if I would use this Bollinger Band or the ATR multiplier 1, and if I only asked, I go into the market long and don't care when, but I would set the stop loss exactly to the lower blue line, then you would see that here, for example, we would be out of the market, so stop loss would have been reached, but in most of the time we could live with exactly that stop loss. But maybe we need a little bit more, and then what you can try personally, and you may draw your own chart with your own underlying, with maybe some old traits of that kind of strategy, and then you can play around simply with that ATR multiplier, and you might see, okay, now there are a little bit fewer cases where my stop loss would have been reached, and that might be a good idea for you to get those numbers, this ATR multiplier, for your own strategies. Just looking to the chart, looking a little bit to the history, and get a feeling of within my personal strategy, whatever that is, what number would be suitable for you. So the Bollinger Band might help for that as well. Okay, so that is my answer of that question, and I think it's a good idea to share with you. Yeah, and the other question has been that last week we have had a look on what I call the typical movement of the market based on a certain time period, and what we calculated was the movement, for example, after 5 minutes, after 10 minutes, after 20 minutes, and I double always that number, so 40, 80, and so on. and we have seen how the typical movement of a specific underlying would go. And what we have seen was this kind of chart. And yeah, so we saw a more or less a square root behavior, and we have been able to distinguish between the different Forex underlyings and realize that, for example, Forex pairs like Euro, British Pound, Euro, Swiss does not change that lot, whereas other Forex underlyings have much more typical movement, like, for example, Australian dollar versus Japanese yen, which is more than double in terms of what is a typical movement. And now the question, because that participant wants to know, he wants to go with that kind of information for example, typical stop losses. But the question has been, and I go to my slide once again, the question has been, what might happen to, no, I'm wrong, sorry. What might happen if we look for the typical high-low difference within a certain time period, and not the until now calculated close-to-close values. So what I did was I have two values, the close value of the current candle and the close value of a candle 10 minutes ago, 20 minutes ago, and so on and so on. And I do my averaging. But now the question is, if we consider the highest value and the lowest value within that time period, what changes do we get in that picture? And might that be a good idea to have this kind of information for stop loss setting or target take profit setting as well? And I did that exercise looking to the differences between high and low. And the result is simply this one. And first view for everybody would be, oh, it looks pretty much the same. But let's have a closer view on that. Once again, we see Australian dollar, Japanese yen being first or being highest here, and the lowest, once again, Switzerland against euro and British pound against euro. But look to the scale. The scale here goes up to 7, and the other scale has been only up to 3.5 or 4. So, but the overall behavior, so this square root-like behavior, is once again exactly the same. And I can show that once again, like last time, if I simply do double logarithmic plot on the chart, and let's do that exercise for a minute here, and you will see once again those straight lines, meaning that there's a power law as a principal dependency between time and typical movement, and that it is once again very close to the square root behavior. I can show you just by one example, and we get that straight line, and the exponent here is once again close to 0.5. Okay, so we have the same kind of time behavior, and what I did now is simply I have those numbers which are the typical high-low difference after a certain time, and I put here the old table being the differences between close values, and then I simply did a calculation, the one divided by the other, and that is the complete table here. And if you have a closer look to those numbers, and I did already here an averaging of all those numbers, then you can see it's a constant factor of 1.7, more or less constant over time, constant over underlying. That means you can, out of one number, you get all the others just by multiplying. So consequences, yes, it's a good idea to have those values as well, those values of high minus low, as being a function of a typical time scale. We find, once again, the square root behavior, which is indicating that everything is close to random. And I made that remark already last week. And we have a new good information for each Forex pair. So in terms of what kind of stop loss should we go for a typical trade, where we have in mind, oh, this trade should have a duration time of maybe 1 hour, or we look for a trade on a D1 base. Then we get those typical numbers, and we can use that kind of information for stop loss setting as well, instead of using the ATR. So those two informations, I think it was a good idea to share those questions which came up via email, and that you have this information as well. So whenever you have a question, just send me an email. And on the last page, I will show, once again, you have an email address, but it's quite simple, stefan@trading-stars.de. And of course, that is exactly the basic understanding of that webinar series, that you have the possibility to ask questions during the webinar, or just by sending me an email. And of course, I share those kind of informations with all the others. If you want to have it just private, just make a note, then I will not mention those kind of questions in the next upcoming webinars. So now I want to go for a very simple DAX strategy based on an EMA. And you see here already how this strategy should run. And I want to use an EMA as an indicator or whether being long or short in the market, with a quite simple logic. And this is the close price of, in this case, D1, is it above the EMA value, then I'm going long, and is it below, we go short. So let's have a look in that chart here. Once again, I delete the indicator, I change to D1, and what I would use here is simply an EMA value. Let's start with 200 in this case. And now, where's the indicator? Maybe not within the picture. Oh, that was the wrong indicator. Sorry for that. Now I have the right one. Okay, and now we have it. So always a question, whenever we cross the EMA, we would change our trade direction, and already with the bear eye, you can see that at least for the last couple of months, this strategy would have not been very profitable. But anyhow, let's look to the history as well. So we would change here at that position. We would go for short because the close price of that candle is below the EMA, so we would went short. And finally, because that candle is still below the EMA, with the close of that candle, we would enter long once again. In this case, this candle would have not changed our direction because the red candle has a close price still above the EMA, and the next candle has a close price above once again. So we would have been still long. Change in direction would have happened here. And once again here. So you see, at least for the EMA 200 and at least for the last couple of months, this strategy would have not been performing quite well. But let's see to the history as well. But that is a principal guideline of that strategy. The consequence is quite easy. We are always invested at every time and only change between long and short. And although I mentioned in the introduction of this webinar series, I would never enter a trade without stop loss, and I would never do calculations of strategies without taking into account spread, swap costs, and so on. We start without all these kind of informations. I do it only because for simplification, and you should know that within the next webinars we would change, of course. We will change those assumptions. That means then we take into account spreads, swaps. We put a stop loss on every trade, and we will use ATR multipliers for stop loss management. So that is only introductional now. My goal here is that you see how easy it is just in Excel to get this kind of strategy investigated, and that you can understand already how it works with the concept of neighborhood analysis in order to avoid over-optimization. So it will be a DAX strategy. So I will really start from the scratch. That means first of all, we need values. Values means historical data. And in this case, for DAX D1, a good source is always Yahoo, and then finance, and then you go to markets, indices, Germany in this case, and here we have the symbol is G, DAXi. It sounds a little bit crazy, but this is a DAX, and now we can download the historical prices. On the English side, you can do the same steps as well. And then we see that we get a history down to 1990, and yeah, let's simply get those values here, and we can store them as a so-called CSV format, which is a text format, and let me call it simply DAX Yahoo, and I can store those, for example, here. So now we have stored those values, and we can go to the values or not. Here I have done the exercise already once, so maybe something went wrong with the storage. Let's do the step once again. Save, and not in the folder recordings, and I want to call it DAX Yahoo. It should be there already, and now we have it once again. And then we can open it in Excel, or in my case, I use LibreOffice, but it's the same in Excel as well. So we have now the values all here, open, high, low, close, and we have an indicator for volume we don't care about, and the adjustment close value we don't care here as well. So we can delete this columns. The next step is you see the order is the newest is the highest here, and this order I would like to change so that I have exactly the opposite order. So that means we have to sort them against date, and now we have the reverse order. So the oldest value is in row number 2. So now we have all the DAX values, and I want to really show you the steps how to create this kind of strategy within Excel. I make some empty lines above so I can use that space for later use. And the first is now I have to calculate the EMA value of my close values. But how to calculate an EMA in Excel? What I do in those kind of questions, I look to the internet and have a look to some sources or some ways of calculations, how to do it. And here in this case, once again, the site is in German, but you can find similar pages in English as well. And you see, or the most two important steps is one formula here. So how to calculate the EMA. It's based on the close value of the current candle minus the EMA of the previous one, and that times a certain factor. I come to that later. And then plus the EMA of the previous candle once again. And that factor we use here, this EW as a function of t, is a constant factor. In a way, it's 2 divided by n plus 1, and n is exactly the EMA period. So it's a simple formula, and of course it's different from what is called the SMA, the simple moving average, where you calculate a constant, an average of maybe the last 20 values. In this case, we use the EMA. It has some advantages, even on practical calculation. In the practical calculation, you will see that in the Excel sheet as well. So we remember the kind of formula here, close value minus EMA previous times that factor plus the EMA of the last candle. And we can do that here as well. Let's assume we have a 200 period for EMA, and now we need a first value. That's always a little bit tricky with the EMA because your history starts somewhere, and the first value you simply take the close value because you don't have any other information. So let's, as the first EMA, we use the close value itself. And the second value can now be calculated exactly according to that formula, and that formula tells us we have to calculate the difference between the close value and the previous EMA value, which is this one here. And this has to be multiplied by 2 and divided by the EMA plus 1. And this once again plus the previous EMA. Since I want to use now the functionality of Excel to get downwards, we have to be careful, because in this case we need a $sign in front of F4, because then this is not transposed, and it's always this value of that cell, this F4 cell, with a period for our EMA. And now we have the EMA values. Quite easy. So this is an easy job doing. So we have the EMA EMA, and now we can change, for example, the period, and we get instantly all the new values for the EMA. How that kind of chart looks like, you know, and therefore I don't draw a chart on that here. And now we want to know, are we invested short or long? Let me write it a little bit longer. So whether we are long or short, and I go already here into the second line because later you will see that we have to know the previous one, and we don't have a previous on the first. So, and the answer whether we are long or short in the market is quite simple. We asked if is the close value bigger than the EMA value, then we are long in the market, and for long I always use the +1, and if it is the opposite, I have a -1. So now I can differentiate all my states. That means you see clearly whether you are invested short or long, and you can see always the changes quite easy here by changing the sign of the one. So in this case we are long, and on the next day we are short again. And now the question is, how can we calculate the profitability of that kind of strategy? And that is quite easy. What we have to do is we have to ask ourselves, and I go once again one line lower here, we have to ask ourselves, how is the current day be running, or has it been a profitable day? Do we gain or do we lose money? And I do it simply in percent because the DAX value is in the history here at 1,400, today at around 10,000, so we should do it percentage-wise. And so the profit of exactly one day can be calculated quite easy. How is it that can that be done? So we know we have a current close value of the today of the current day, which is E8 or the 1,420 in DAX values, and then we can subtract here the close of the day before. And since we want to have this in percent, we divide once again by the close value of the previous day. So up to now, this is only the percentage-wise change from one close to the other close. So in this case, we know, okay, there has been a 0.37% increase in the DAX value. But now we look to the previous day. At the previous day, our long-short indicator has indicated us that we have to be short. So we know we are short for the day after. And that means, in this case, this 0.37% have not been a profit. No, it has been a loss. And this is quite easy because we have been short. Now we simply can multiply this by our long-short indicator, but we have to take the previous day, because during the day we will never change our trade direction. So in fact, now we have a minus day. When you do calculations like that in Excel, you have always to ask yourself, what is the time flow, and when do you make decisions, and in what cell do you have the information of that kind of decision. So if I look here, I know the day is over. I have to be short in the market. And in practice, I would, exactly before the market closes, I would go short. Okay. And then on the next day, we have a look to the close value once again. And so the calculation of that profit for that day is the previous indicator of our direction, so this -1. And then, of course, we calculate the percentage change during the day based on close to close. And therefore, we have here simply the profit in percent of that specific day. And we can do the same exercise for all the other days as well. And we have automatically the right calculation between long and short. We always look to the difference between close to close and multiply it with the sign of our investment, so to speak. And then we can do simply adding all those values up. Let's start here with the first trade, and then in order to get everything summed up, we have always this kind of formula, the today result plus the sum of the history, and then we have everything summed up here. And now we have it all down here. And just I put some zeros here that is easier for drawing this as a chart now. And let's have a look to that. So we have here the sum of all percentage changes, and we can have a look to our chart here. So what you would see here is the profitability of our strategy. Let me change it to lines. Then it's a little bit easier to have a look to that chart type, and lines is a little bit easier to look. So this is the profitability of our strategy. This very simple long-short strategy being always invested in the market, and now we have the complete history, which is more than 20 years calculated for that kind of strategy. I know that to live up right now with the percentage numbers is not that easy to translate into something. Hey, how many euros do I earn with that strategy? Let's at least do another plot here, really in terms of the profit in points, because then it might be a little bit easier for everybody to translate this in euro values, for example, and the calculation is the same than before, but we only have to take here the close value minus the previous close value, and that times whether we are long or short. And now we do not divide by the previous day, so we have the absolute number here of that change, or the absolute gain or profit, or in this case it would be a lose. Then let me do it with red as well, so negative numbers in red, and we can have the same here all over, and then we do the summation, the sum as well. That's quite simple. Let me have 2 zeros here as well. And then we can have a look to the profitability in terms of absolute DAX change. So if you like to translate that chart into, for example, euros, then it's depends, of course, on the broker. But let's assume you have a broker where 1 point is €1. Then you have here already the complete information. Let me do it a little bigger right now, because that might be, now let's have a look to both charts. So just 1 second. Oops. Because now the next step I would like to do is I want to do changes of that EMA value, and simply in order to have different parameters for our strategy. So in principle, both graphs look quite similar, but of course, you will see the differences if I change the EMA value. So that is a quite short period. Let's, in the first step, just double that number. Then you can see, oh, yeah, it's getting better, especially if we look percentage-wise, which would be the better way to optimize the strategy, because of the historical values being quite low, and now we have numbers of 10,000 for the DAX. But you can see this is your equity curve within your account, in principle. And you see, okay, it's behaving quite good until about 2009, 2010, and then equity goes down. Let's change the EMA period once again, and I do in this case, for example, always doubling. So now we have an EMA period of 80. The start is quite similar. It goes even lower in the end. Let's change it once again. And now it gets a little bit, yeah, how to call it? Does it get really better? We see that we don't have that sharp going down at the end. They're still going down at the end during the last couple of months, but it's already a little bit better. And just the next step, 320 as an indicator for as an EMA period, it goes into that direction as well. So first answer here is, okay, we have already an idea that this kind of strategy might work. But the question is now, how do we get a good number for that EMA value? And you might remember to the last webinars that it's not that easy to exactly define what is a good number, because we have to think about the question, what one do we want to optimize? And I told you already there that I look for maximum drawdowns within the chart, the slope of the equity curve, and so on and so on. So it's getting a little bit complicated. Since we do the first steps here right now, I want to show you how you can get already a feeling for that kind of strategy. So what I would like to do is I simply would like to get two numbers. I don't care right now about maximum drawdown, which will be an improvement of that kind of development in the next weeks. But at least what I want to have is the slope of that equity curve. And let's draw a line for that. If my computer is not too slow. Oh, now it's happening this one once again. So I have to close it. let me cancel that. I will do it a little bit different because I get now here into computer problems. Just a second. I hope I can recover everything here. If it does not work, I can still at least have everything cancelled, and then, yeah, let's see. Okay, hopefully, yeah, it goes this way. We have another chance to get that slope. Not only within the chart, we can calculate the slope even straightforward in Excel. And it's simply slope because it is fitting a line into the values we want to have. And you do it this way. And now you have the slope of your equity curve here. And the other value is always what I would like at least already to get here is the so-called R square, or I write always R2, that is the linearity of that equity curve. And there we have to use R as Q, and this relates this value once again. Let's do it manually. Okay, and this is now the linearity of that equity curve. And since now what I would like to do here is I want to get a table with values of EMA, the period, then the slope, and then R2. So, for example, I would be interested in, let's start with that value, 320, and then we have those values here for slope and R2. You will see in a minute what I would like to get here. And now I want to have, let's start once again maybe with an EMA of 10. And so I have to change here the 10. And in order to get everything here a little bit quicker, I put here the EMA value. And I connect that cell with here, because now I can always just copy those three values down here. And let's do the steps as previous. For 20, for example, and so on and so on. Let's do that step quite quick. And then you will see in a minute how the picture will look like. Because what we then will do is we will plot the EMA value. Let's sort them. The EMA value versus the slope. And let's only do this kind of plot. And that's all. What we can now do is we can ask ourselves how to find a good EMA value. And you see already, until now, the maximum is at 80. So we might be interested in values around that 80 So let's have a look to 60. And we can use that number here as well. And we get a new spot within our plot here. And let's go to the other side. And we get the next value, which is once again lower. So we can see somewhere between those numbers, it might be good values for the EMA. But up to now, we don't have so many higher values. So let's put some higher values as well to see whether something is going better there. Oh, no, sorry. And here I have a mistake as well. Let's see, because the first row here is wrong. I will correct. The difference is between copy-paste with formula or without formula. So now I have it right. So we see our maximum here. We see a maximum here. We don't know exactly in between. And you can see how you can develop everything just putting some numbers here. And you get always the slope of the equity. And of course, we want to know now what is the best. Now I shortcut everything because I have done this exercise already for much more values of an EMA value so that you see a more final result. So let me switch here to what I have prepared already, to that kind of picture. So what do we have here? In principle, it's all the same than we have done already during the last couple of minutes. We have on the left hand, we have here the equity curve for that specific parameter. And then what we have is here a plot, and I will change it a little bit for you because first more like the chart has been in our other Excel sheet, because at that time the EMA was not. So what we originally have is that kind of behavior. And of course you see already good points for EMA values for that kind of strategy. It's always those maximums here, those maxima which are good values. But the first step now is, before we do really the so-called neighborhood analysis, is the question EMA. Is a linear consideration of an EMA a good thing? And my answer is clearly no. Because as a linear consideration means, if I have an EMA value of 20 and I go 2 points higher, then I'm at 22. That has maybe already an impact. But what happens if I have an EMA of 200 and I go 2 points upwards? Then I'm at 202. That is not a big difference. So looking to EMA values on a linear scale doesn't make sense. It only makes sense if we change our view to a percentage consideration, which finally means we have to switch to a logarithmic y-axis. Sorry, x-axis in this case. Why do I say it's more a percentage consideration? From 20 to 22 is a change of 10% of the EMA value. Then this should be compared to a change from the EMA period 200 to 220. Then we have in both cases a 10% change of that EMA value, and to compare the 220 with the 200 is much better than the 202 to be compared with 200. So we have to change a little bit our view, especially for EMA values. The story is different for other parameters like stop losses and risk-reward ratios and something like that. But in this case, we need that kind of access. So now it looks a little bit different, and you can see already I have tried to put those EMA values a little bit more equidistant on that scale, and we can clearly see now 3 good spots for having EMA values for that kind of strategy. But in order to do it really mathematically, we do it a little bit different. But before I go to that step, what is important for good strategies? For good strategies, it's always to enter plateaus for our parameters. Plateaus means that we have a longer area where we change our parameter and it does not change that much the profitability of our strategy. And you can see here already that the maybe best value is not this one here at around 80 or 70, and even not this one here. In principle, this has a higher profitability, but you can see that it's more a peak-like behavior. The biggest plateau behavior we have in the range of 250 or something like that. So the favorite already just by eye is to have a strategy running on a very broad, very long plateau of parameters, because then at least we can assume that the strategy is much more stable than if we go for a peak value like this one here. And we can do this step finally, formally. I will go already to the final result here, because what I have done finally, I have really done an equidistance in terms of EMA values always by 10% from one value to the next. You can see that here because I have always multiplied the EMA by 1.1, which means on a logarithmic scale we have values which change by the same amount. And then what we do is simply we put an average, for example, of this size to our slope values. And in this case, I have a central value, and I go for the 2 neighbors upwards and the 2 neighbors downwards, and then I do my averaging. And what I want to do now is to have a look on what we have here. And you see already the result. What is a good value for that kind of strategy? We have now this slope with neighbors plotted, and still we have this very broad plateau here a little bit after 200, and we have those other 2 here which are a little bit better than in our first graph. But now we can indicate what kind of EMA values would be suitable for that kind of strategy, and that is, the first one would be here, something there, 67 and 211 would be the 3 favorites for that kind of strategy. One remark, because I have done this exercise here absolutely mathematically, that means I even because it's mathematically well defined to have EMA periods with comma values, because mathematically everything is defined that way. In an EMA, in an MT4 chart, you would use integer numbers. That means instead of 33, you would use 31. But since we know the neighborhood is good as well, we would know this is a good number. So this kind of neighborhood analysis is a concept to avoid over-optimization of strategies. Still, we have the question, which one should we use now? And my personal favorite would be always the last one here, because there we have the a very wide range of EMA values having good numbers for the slope, and the slope is now the indicator of the performance of that strategy. So yes, it would be something like that. And this is exactly the concept of neighborhood analysis I would like to introduce here today, because I use that kind of technique for each strategy. It will get a little bit more complicated if we have more parameters, because we have to think them not only one-dimensional, like here where we simply can look to plateaus. We have to think 2- or 3-dimensional, but don't worry, it's quite easy because we can do everything mathematically, and then it's easy to maneuver in those high-dimensional spaces as well. So it's not really a problem. So as a first concept, we know already strategy looks good. We have some certain ideas of EMA values which we can use. And you have already seen how simple it is, how we can go for from historical data already to an idea of a strategy, done everything, every step is just in Excel. So if anybody would like to have those Excel sheets, no problem, just send me an email, and I will send you those Excel sheets as well, so that you can do your own investigations, maybe on other underlyings, because I can tell you already, you can have similar strategies on a lot of underlyings which work well. But of course, I have to mention some simplifications up to now. No spread, no swap costs, and so on. And finally, we want to have trades with a stop loss and not without stop loss, because formally, in this case, we have not set any stop loss. But it's a first idea of a strategy, and we will do the next steps exactly next week. So once again, you have all the information here on that slide, how to contact me, how to contact Argus. So it's quite easy. Yeah, hopefully you like those kind of informations in order to develop superb trading strategies. And the hour is already over. It goes every time very fast. So thank you for your attention, and have a nice day. Bye-bye.